Hey guys, Toby Mathis here with Infinity Investing, and today we're going to talk about what you should do if you have a bunch of cash saved up. All right, so what's the current situation in our economy? We've never had this type of inflation. I would say, period, but I would say not since the 80s. Like we're a good at least 4 decades since we've seen this type of craziness on the inflationary levels. And I would argue that on a lot of items, it's significantly higher. Gas is 50%, food has gone up 30, 40%. Like there's some huge inflation, even though the number that came out, I don't want to date this thing, but today was 7%. We're seeing massive inflation, which means your money is melting. Inflation is a hidden tax. To me, it's insidious and it really hurts those that cannot afford to be hurt, right? It hurts the poor, the people that are the working class, because their money is getting devalued. The money of their wages and everything, they just got taxed 7% on everything. Like if somebody says, hey, I'll just do a 7% flat tax on everything you own, right? That's what inflation is. It devalues it. The best way somebody explained it to me is if I put $1,000 and I froze it in my freezer and I go to pull it out a year later, and part of it melted. 7% melted. There's no longer $1,000 there. Now it's 7% less. It's whatever that is, 9,300. Right? There's a big chunk that is no longer there, and that's what your cash is doing. So, what does inflation boost? That's the questions you should be asking. Is if I have high inflation, what's the hedge against inflation? You're always going to hear gold and silver and stuff. That's nonsense. It does not correlate. You know what correlates kind of weird is inflation seems to correlate directly with the cryptos, not in the way that you think either. It's just kind of bizarre when you look at these. What actually is a hedge? What is a hedge to inflation are things that inflation makes more expensive. Easiest way to look at it. So when there's inflationary and your dollars become less valuable, things that you used to buy with those dollars tends to go up. So real estate and equities are the big ones in my book. Real estate and the stock market tend to get lifted as inflation is going. In fact, many investors, I use an example of Ray Dalio, the two biggest drivers on the growth in the equity market are growth and inflation. Growth meaning, hey, there's more people putting pressure to try to make something more valuable. That's going to drive up an equity. Hey, lots of people trying to buy it. It's going to make the price go up, supply and demand. And then inflation making everything that if I'm selling widgets and I'm making widgets, inflation makes the widgets more. Okay. So I'm just raising the price of my widgets, right? That's inflation. Makes the company more valuable. That's just it. So you want to be in those two areas. If I have a bunch of cash, then I really do need to expose myself to those markets. The problem that you have is if somebody's in retirement age, or they can't afford a fluctuation in the market, they get very, very uncomfortable in these situations because we have this inflation. On the same token, we have really, really low interest rates, which means bonds don't pay anything. So normally, if you're 80 years old, you're going to have 80% of your income tied up in, or of your assets in bonds, right? Hey, bond says I'm going to put this much in, and this is what you're going to receive on this date. It's very, very straightforward. The problem is it's not paying much and it's less than inflation. Generally speaking, the way you combat inflation is to raise interest rates. So you've heard the Fed say, hey, we're going to be increasing interest rates. And what do the markets do? Every time the Fed says we're going to increase or we're going to get more aggressive and things, the market goes down because inflation pops up the market. If they're going to raise interest rates and drive inflation down, that's the combat. For inflation, it's going to push a lot of these companies down. Plus, it's going to make it more expensive for these growth companies to get the money. So I would not be going into growth companies. I would be running away from growth companies if the Fed's going to be raising interest rates. I'm going to be running towards anything that is a cash flow. And so what would I be investing in? I tell you what I invest in. I'm not going to tell you what to invest in. I'll just say what I do is when I have cash and there's high inflation, I am buying real estate and I'm buying income producing companies in the stock market. I'm buying revenue streams because that revenue stream doesn't care about interest rates for the most part. It doesn't care about inflation for the most part. The revenue stream is value. Like if I said, I'm going to give you $100 a month for the next 100 years, you could value that. You could say, what is that worth right now? That's what I focus on. I don't really care about anything else, right? I know for certain that if I keep it in cash, it's going to be devalued. I know for certain if I buy an income stream, it's going to continue to be more valuable. Because if that inflation goes up, the income stream goes up along with it. If interest rates go nutty, if I have a company that is not debt contingent, like it has a good cash flow, and there's a ton of them, but you're looking at companies like the Walmarts of the world, the Coca-Colas, the Procter and Gamble. You're looking at companies that, hey, even when these things have happened in the past, it didn't change the way they treated their shareholders and the amount of money they paid. Right? They always pay their shareholders, and that amount increases every year. So when I'm valuing it, I am now untethering myself from crazy inflation and the cost of materials and things like that. I am basically saying I am buying a revenue stream. If we have runaway inflation and continues to bolster those things up, okay, my revenue stream is going to grow. But if they combat inflation and the Fed raises interest rates and it starts to push down even the value of my company, let's say that the value of my shares goes down. I didn't buy the company hoping that it goes up in value. I bought a revenue stream that's not going to be impacted by those moves. Because historically, like I could go back and look at the 80s and 90s and say, oh, every time they do this, or in the 2000s, when they started raising interest rates after the, in the recovery cycle, after the recession, and you're looking at it going, oh, these companies did really, really well. That's why you buy, and you tend to hear me say, I'm buying companies that have been increasing their dividends at a minimum of 10 years. But I tend to look at 25 and 50 years. I tend to focus on the dividend kings because they've been increasing their dividends even through all these other cycles in the past. So we don't have a crystal ball, but what we can do is say, well, what happened in the past when this company was hit by this? Well, you're going to be very limited to the number of companies that were hit by this and still paid out increasing dividends every year. In fact, the world's going to get to be less than maybe 20 securities. And of those securities, we're looking at the value of them right now. You're probably going to have one or two choices. And that's what I'd be focusing on. I'd be like narrowing this market down. I'd be getting rid of all the growth plays. And I'm going to say, if I'm sitting on a lot of cash, I'm going that route in the stock market. Option number 2 is put it into real estate. The real estate market is going bananas. That's because there's a ton of demand and we're underbuilt in a lot of areas, like significantly underbuilt in the area of low to moderate income housing. So we know we have lots of people that need a place to live and there's not enough places. We also, I don't know if you paid attention, but, real estate prices last year overall in the nation were up about 20%, in some places 50%. Real estate is absolutely nuts. So we do the exact same thing. What is being impacted by the low interest rates? Well, affordability. So we do not want to go compete with people that are buying, their homes, home to live in, their forever home, right? That's absolutely untethered from reality. What we are going to buy is income streams again. We are going to look at rental real estate that is producing cash flow. And because of what's going on in the economy, it's getting to be a very, very narrow world. We tend to look at single family homes, manufactured homes. The apartments are just getting jacked up there because all the funds want this huge multifamily. It's not saying don't do it. I'm just saying that it's very, very competitive. Whereas mobile home parks, about 90% individuals. It's not institutional. When you see BlackRock coming around trying to buy everything, they're focusing in on markets where they're looking at appreciation. They're not looking at it the same way we do. They're looking at it going into some of those markets, driving up the cost of homes. Whereas we're looking at markets that produce cash flow. We're buying an income stream. Again, X number of dollars for the next 100 years. Here's what the value is today. I can sit here and actually start penciling that out. Usually you're buying it on something called a cap rate, which is the amount of money you're making on the investment. So I'm buying something for positive cash flow. After I buy it, I don't really care what it's worth, right? Because I'm not going to sell it. I'm buying it. I'm just turning it from cash into something that's producing income. I'm buying an asset with it that if inflation continues to go nutty, real estate's just going to keep getting pushed up with it. So my real estate's just going to go up. If real estate goes up, then the cost of rents are going to go up along with it and get pushed up. Everything becomes more expensive. We saw this the last year, 2 years, and it's just going to keep going on. Now the Fed, again, how do they combat it? They raise interest rates, which causes affordability to go wonky, and all these people that are buying houses, it's just like 2006 and 7, right before we had that crash, 2008, we came home, but you could see the same stuff. People are buying houses that don't pencil. I couldn't rent it for what I'm buying it for. And that's where they get into trouble. I actually use a ratio, and that ratio is getting high. And I use the ratio of the average cost or the cost of a single family home, and I compare it to the rental value. And I just overlay those. And usually you're in a ratio of 1.3, 1.4, you're safe. We're getting close to 1.5, which says we're pushing up on those values. People are starting to buy it because they say affordability because the interest rate's so low. But if they were not able to pay it, if they weren't able to pay that mortgage, could they rent it and not have to sell? And the answer is getting to be right now it's still a yes, but we're getting closer and closer to that no, which is the tipping point, where all of a sudden people, they're going to get foreclosed on, right? So we're going to see that some point probably in the next year and a half, 2 years. I don't see it right now, but I think we're getting close. And unless the rents, inflation continues to drive up the rents, we'll see that ratio come back in. But if we have this 20% growth in real estate, unsustainable if inflation's 7%. Unsustainable. So it's not going to be something that we're going to be able to keep up. We got the wages need to keep track. Unless wages are going up 20%, in which case then you could afford the rents. Otherwise, you're going to have a situation where the rents on those houses will not allow that mortgage to be kept. So people are going to lose their houses. They're going to be going into foreclosure, right? So the affordability is starting to decline. I'm not saying the real estate market's going to crash. I'm just saying that it's not sustainable at its current level. So it's going to slow down significantly. So I think it's going to get cut. Is it going to be cut in half? I don't know. I don't have a crystal ball, but I can certainly say that from what I am seeing, you want to buy cash flow real estate. The reason that the comps and single family houses for people that are buying the house for their home are going crazy is because there's so much competition to buy those houses because money's so cheap. Fed raised rates, and it starts to affect the cost of that money. And all of a sudden, the affordability goes down. Now you don't have as much competition. The house prices don't go as fast as they are. All right. I know I threw a lot at you, but hopefully that tells you what should you be doing. If you're sitting on a lot of cash, you should be looking at deploying at least a portion of it. And I say you should keep about 10% of your monies or your total net worth in cash or cash equivalents. Cash or cash equivalents are US dollars or other dollars. It can be some crypto. So if you like the Bitcoin and Ethereum, those are the two that I tend to look at, probably more towards Bitcoin. But Bitcoin and Ethereum could be in that mix. Not a huge chunk, but a little bit of that mix. If you like the gold and the silver and you're one of those people that just really, really believes in precious metals, by all means, I do have some too, but it's not going to be more than 1% of your net worth. You could acquire some of those. But what you really want to be doing is making sure that you have income producing assets. If you're sitting on a bunch of cash, because I could tell you with inflation, your cash is being devalued. So you don't want to keep it there.